All right. Hello, everyone. Thanks for joining us again for the next webinar in our ongoing series. And today we're going to be talking about the advanced planning topic of insurance and some of the fundamental concepts that you need to know and be aware of. And this is part of some of the great content that we've been putting out, which includes a bi-weekly webinar, which we're doing every Monday at noon, as well as a weekly email called Fairfax Friday. And in that, we give you basically the quick hits of what you need to know for the week, as well as a bit of perspective and wisdom. So our goal is really to take everything that's going on out there and whittle it down in one nice little package for you. And all of this can be found on our website by going to bearwealth.com and then the Bearfax at the top of the page. And this webinar will be there as well. To quickly recap what our financial success matrix is, it's basically the foundation and the core of everything that we do with our clients. And for anyone else out there watching, it's something that you should consider, maybe what you currently have or what you might be working towards. And we call it the financial success matrix, starting at the bottom with a really strong financial planning foundations to get you up and running, then focusing on investments and strategies and how those are incorporated into your plan. And then finally, advanced planning topics, like one of the ones that we're going to be discussing today. So you may be at various places with your financial success matrix, but we encourage you to think of it in this way.
Yeah, so today I think we're focusing on the types of risk that that people take. We're going to talk about life insurance, whether or not you should have, what kind of life insurance you should look at getting, whether it be term life insurance or permanent. And then how do you decide how much? Because oftentimes people just throw out a random figure, and there are ways to actually calculate how much life insurance should you own. And we're going to get into specific examples, but what do you insure, right? You don't insure just any and everything. You don't insure the fact that, or some things you can insure. If something is exceptionally dangerous, and if you do it, there's a high likelihood of it having a bad outcome or severe outcome for you. That's not something I would advise anyone to do. You should just avoid it at all costs. Or in the opposite, it might be something that happens all the time, but the severity of the outcome is very minor. So it's not something you're going to want to buy insurance for. So what we insure are outcomes that are extremely severe to us, that have the potential to be severe, but are also rare. That's what you want to try to protect against. And then I think Mark has come up with some great examples of how that can work.
Yeah, no, you're exactly right. So talking about these key concepts of frequency and severity, and we put together a few examples to walk through each, as Kenny was explaining there. And we'll start with the high frequency, high severity type things. These are risks that you would want to avoid at all costs. For example, if you were looking to purchase a home, you'd be pretty unlikely to go and buy a house that is in a flood zone that consistently floods. That just wouldn't make any sense to do, right? Because it's high frequency if it's in that flood zone, and the severity of that is also very high. So what would you do? You wouldn't purchase the home that's in the flood zone. You'd go purchase a house that's somewhere else, right? That seems to make sense thinking about it in that example. Kenny, what about something that's low severity and low frequency?
Yeah, so, all right, I mean, let's say you buy a pair of sunglasses, right? And they're nice.
Really nice sunglasses.
Really nice sunglasses. So you're going to want to hold on to those. Now, I have given up on that because I find it very difficult to hold on to them. So I lose them with constant regularity. So if it's not that severe if I do lose a pair of sunglasses, but it would be more severe to me if I lost an expensive pair. So what do? Is I might make an adjustment. So instead of buying expensive sunglasses, I buy cheap sunglasses, which lessens the severity of of losing the pair. This is certainly not something that I would buy insurance against because the severity isn't that severe, but it also, you can reduce that risk, or you can avoid that risk by making an adjustment in your life. In this case, instead of buying expensive sunglasses, I might buy cheaper sunglasses if I'm the person who has a tendency to lose them.
Yeah. So, I mean, you've still got the sunglasses, but you've reduced the risk in this instance of messing up your fancy Gucci sunglasses or something. And instead, you accept or reduce the risk by saying, well, I still need them, but I'm going to buy some cheap ones. So if I lose them, if the dog eats them, if something happens to them, I'm not that concerned about it.
Right.
But on the other hand, I'm not going to let the dog eat up, multiple pairs of very nice sunglasses.
Right.
Yeah. So again, the
Yeah.
low severity here, we're talking about just sunglasses. It's not like it's a house or something of all that much importance. But even with the severity, there is still the frequency that we've got to factor in.
And Mark, a fun fact, those are your sunglasses actually in the top left there. And I know that would be pretty severe to Mark if he lost that pair. Because
it would be devastating.
Looks very snazzy in those, I must say.
All right, so then let's talk about this missing link here with the low frequency but high severity. Think of this as something that is just catastrophic. And in this case, you've got to insure it. There's no questions asked. This is the example of a car wreck, right? It's something that, God forbid, doesn't happen very often and hopefully extremely rarely. But if and when it does happen, it has the potential to be really catastrophic, both personally as well as financially. So it just seems obvious to us in this type of example, well, yeah, that's a risk we're absolutely going to insure. And that's what we hope you take away from all this, is thinking about these different parameters when making the assessment of what should I insure? And then the next logical question becomes, well, how much do I need to insure things for? So in summary here, we put together a little flow chart for you. The first, as far as how to think about this, the first question you should ask yourself is, can you afford the risk? And if the answer is yes, then you don't insure. And if the answer is no, then you've got to dig a little bit deeper. What's the chance of occurrence? And then from there, you can make your determination. Because look, you can get insurance for everything. I mean, if you go buy a new TV for a couple $100 from Best Buy, they'd be happy to sell you the extended warranty or the insurance policy just in case lightning strikes your house. Or if you buy a new car, they'd be happy to sell you the insurance in case you scuff up your wheels or something like that. So you've really got to be careful to not overpay for something that you don't need to be insuring.
Yeah. So all right. So obviously, the most catastrophic thing that can happen, and the most valuable thing for the vast majority of people out there, if you're not already retired or you're not very close to retirement, is your ability to go out and earn money over the next decade or however long you plan on working. And that typically is your most valuable asset, is your ability to earn an income. And so how do you insure against that? How do you protect your family in the catastrophic event something happens to you? You have to have life insurance. Life insurance is really the way to do that. You can buy a term insurance policy, which is going to last you for a specific period of years. Let's say it's 10 years, 20 years, 30 years, what have you. It's going to cost you the exact same dollar figure every year during that period. And either it will end at the end of the term or it'll become 10 times more expensive at the end of the term. Just depends on the different carriers and different types of policies. It's a great fit for people that are, I know I want to retire. By the time I retire, my children will be out of school. I'm going to have saved X millions of dollars. And that, if something happens to me right after I retire, the money and the liquidity that I will have is going to replace any life insurance that I would have owned anyway. And it's it's very simple to plan. I'll have this amount of insurance for this number of years. Now, others might be say, I want to make sure that I have insurance when I die. And if you want to make sure that you will have insurance when you die, without knowing when you're going to die, you got to have some type of permanent insurance, some type of life insurance that'll be there when you're 55 or when you're 105. And that obviously is going to, one, it's going to cost you more money. It's got other ancillary benefits, and that there's buildup of cash value. That tax cash value has favorable tax treatment. And it can be used to things like, paying estate taxes. So if something happens to you, that money can go into your estate and used to pay taxes. And it's a great way to leverage that, because no matter what the benefit is, the cost for receiving that benefit is still going to be, pretty small. The sooner you were to pass, the greater the reward would be in terms of the dollars you put in. Versus the longer you live, you will have paid more money, but it is an assured way, no matter what happens, no matter when it happens, you really know how much money you're leaving for your family, for your heirs. And it makes planning planning easier. There can be lots of different reasons to have either, but those are really the two different types of life insurance: the term and permanent.
Yeah, and I think, there's a lot of different nuances that can go into, well, what should you have, but I think this is a really good fundamental breakdown with some of the basics. And look, for the vast majority of people who have, let's say, just a pretty straightforward situation overall, term insurance is often the most favorable option because of the factors that you see here. And when you think about insurance, you also should be thinking of what is the purpose of the insurance, right? We really shy away from recommending that you think of using an insurance product as an investment vehicle, because those really are two different things. Now, there's products out there that are designed to operate as such, but it doesn't mean that it's necessarily what's best or what's right for you. And so there are many number of situations where permanent insurance makes sense, like we have here. If you want to leave a significant inheritance or a defined inheritance, or if you're planning for estate taxes, or business succession planning, or buy-sell agreements, or a number of factors, permanent insurance can make sense. But for a lot of folks, it's just getting back to the one simple question and concept of, why am I getting this insurance in the first place? And that reason is to cover my income should I no longer be around and able to earn. That's what you're really insuring against. Again, the frequency and the severity example, it's that very low likelihood, but the high dramatic and catastrophic effect of if something does happen to you.
Right. It can only happen once.
Right. Yeah.
If it does, you want to make sure that your family is protected. Mm-hmm. And I lost my thought there earlier, but what I wanted to say is that, and Mark, you've said this before too, is that the best case scenario is that it expires and it was a waste of money. I mean, obviously, that's what you want to have happen. It's the same with your automobile insurance. I mean, you don't want to have a bunch of claims. You don't want to ever get any wrecks and ever need to file it. Disability insurance, every type of insurance. It's also, it's important to understand that these insurance companies are in business to make money, and on average, they're going to come out ahead, or otherwise it would be a terrible business and nobody would do it. And so that's why they exist, and they serve just a very important role to protect you in those instances where you need them. You hope you don't, but you never know.
Right. Best case scenario is that you just give away your money to the insurance company and get nothing in return. Sounds a little wacky and maybe a little counterintuitive, but that's the best case. And then, like Kenny said, I mean, look, insurance companies are in business because they are profitable. So when you think about what types of insurance, what amount, what coverages, et cetera, that's why it is so important to really analyze the details of what you're looking at getting, whether it's life insurance, property and casualty, or anything else. Insurance is a very necessary thing. Just want to be making sure that you are insuring the right types of things, right? And so on on the theme of life insurance, the next logical question is, well, how much do I get?
Yeah. And so the question about how much you get is really, depends on how much you make, how much you have saved, how much you want to provide for your family. And I can just tell you that I'm sure we all out there listening know people that have had premature deaths, and it's just extremely catastrophic. And I think, Mark, we were talking about this the other day. It's like the reality is you've never heard of one family that said, this guy, he just bought too much insurance for us.
Right.
Yeah, we were overinsured. It just doesn't work that way. It's catastrophic from a standpoint of the family and dealing with the survival. And typically it's going to take a few years just to get back into the normalcy of life and providing the way that it was. And this is not even if you were the primary breadwinner. This is if you were just, you weren't even the primary breadwinner. It's just very, as we could all imagine, I don't want to harp on that, but it's catastrophic, and you just need to make sure that you're doing everything you can to protect your family. And for the most part, it's relatively inexpensive to do a pretty good job of protecting your family, at least using term for a finite period of time. And
yeah, because the other factor is the grief factor, which is really, it's not really measurable or quantifiable in the traditional sense because it impacts everybody differently. But in addition to the other factors that you were mentioning, that's a big one. And so when considering how much, there's different schools of thought out there, but we wanted to highlight two for you. The first of which is, well, thinking about what's the loss of your future income. If something happened to you today, wherever you might be, if you're age 30 or age 50, if you earn $100,000 a year or $1 million a year, what does that mean for your loss of future earnings for your family? Right. And that's one way to almost back into an appropriate amount of coverage. And then in addition to that, they don't always have to be separate, but this is another thing to consider is, well, if something were to happen to you, well, what expenses or what things would you want life insurance to help support or provide for? And so some examples of that would be like, well, we have a mortgage for $500,000. So I know that if I were not around anymore, I would want my surviving family to be able to pay off the mortgage immediately if they so choose. Doesn't mean that they just have to do that, but they have the financial means to take one burden off of themselves. If something were to happen to me, do I have kids or grandkids that I would want to establish an educational savings fund for? And if so, in what amount? That can be another way to layer on how much do I need. If both spouses work and one spouse is no longer there, do you need to really replace two incomes in the sense that one spouse is no longer there, but the other one may need to stop working or may not wish to work anymore? And what are those incomes that you're replacing? Do you have to do things like hire full-time childcare or something similar? And then also just in general, how do you maintain your lifestyle? What is that dollar figure and what does it take? And what are you going to need in order to, again, give surviving family the option to not have to make difficult decisions purely because the money necessitates it. I think that's kind of one of my key takeaways when I think about insurance or when I'm advising clients on, what the quote unquote appropriate amount might be.
Mm-hmm. I mean, the simplest way to think about it, I mean, everything needs to factor in, but one simple way is like, well, what would you take right now for someone to hand you a check and say, you can't work ever again. You can't make one more dollar. You can't make one more penny. It's not like you can go to work part-time. It's it. How much would that be? And most of the time, the instinct is everybody's like, well, I'll take $1 million term life insurance policy. I'm just making big generalizations, but that's what a lot of we hear when people think how much money they need. It's like, well, really? If I offered you $1 million right now for you who's 40 years old and you make $250,000 a year, that's all you think you need, your family would need? You probably need more than that. I mean, and really backing into it. How much do you have saved? How much, what is the purpose of this insurance? And then, Mark said it exactly. These are just things to think of. It's why you need to work with an advisor to help you determine what the right amount is, and not just decide, I need 2 million, I need 500,000, because then you're just not going to end up with necessarily the right amount that's going to put your family in the best position.
Right. Those are just nice round figures that sound nice to say, oh, I'll take $1 million.
Yeah.
Well, that might be enough, or it might be too much, or it could be too little. It's so specific to each unique situation based on, again, where are you age-wise? What's your future earnings potential? What family are you supporting? I mean, there's so many factors that go into finding the right amount. And then I think, Kenny, honestly, another important thing, we didn't put it in here though, but is the subjective factor, because it's not like there's just one exact right number. It can often come down to being a range, quite frankly, of, hey, maybe it's somewhere between $2 and $3 million for you, Mr. and Mrs. Client, because of these factors. And now it's kind of up to you to determine where you want to be in that range. So we try to be as objective as possible, but there's a little bit of subjective too, I think.
Mm-hmm. Yeah, I mean, that's very true. It's a lot of what kind of feels right, and it's feeling that out. I mean, I can tell you for me personally, and I wouldn't want my spouse to ever have to worry about money again. That's not going to be something they have to focus on going out and making, making a living and providing sort of certain lifestyle, because it can be, not that I think, anything's ever going to happen to me, but it's relatively inexpensive for the benefit, just in case something does. And
right.
That's what I would want. Others, won't want their, want to make sure they can get through a few years, and I mean, whatever it is. But it's not right. I can't tell you this is how you should feel, but we can just talk through and understand the situation and what it means for someone to get X dollars or Y dollars, and what is helping you come to a determination of really that right number.
Yeah, for sure. I mean, like you said, that really is the importance of working with an advisor to talk through some of these things, because let's face it, it's arguably the most uncomfortable topic when it comes to financial planning. I would say it alternates between that and estate planning. People just don't like to think about, the bad thing that could happen, right? But it is a necessary topic. And so working with an advisor who can walk you through these ideas and these concepts often is very beneficial to people.
Yeah.
So any other things that you think we should mention as far as life insurance goes, or risk in general?
Yeah, no, I mean, I think that about, that covers it. This is just a real kind of high level. You can get deep into the weeds about all different kinds of, permanent life insurance policy. There's universal life, variable universal life, whole life. I mean, lots of different types of, there's index universal life. So it just depends on what your situation is, what's right for you. Are you trying to build a cash value? Are you trying to just have the highest death benefit for the lowest cost? I mean, there's lots of different factors that play into what type of insurance that you should get as far as life insurance. But I mean, I think we covered the basics there. I mean, anything else that you can think of?
No, I think the only other thing is just letting people know, this is what we help our clients with. And it's something that if you have questions or concerns about maybe something that you've already done or you did a while back, or you're in the process of considering what you should be doing now, let us know. I mean, this is something that is integral to true wealth management and financial planning. So that's what we're here for.
Well, that's a great point too, because it's not just like you buy it and it's done forever. I mean, life insurance policies, especially non-term, need to be reviewed regularly. I mean, they just have to be, because they can have been sold to you with certain interest rate expectations, and those interest rates aren't what they were proposed as. It's just absolutely natural for that to occur. And you just got to look at that, because there might be better alternative now versus what you bought. It could have been 5, 6, 7 years ago, whenever it may have been. It's just something to be reviewed and constantly, be updated and looked at, and make sure that it's still serving the same purpose it did when you bought it, whenever you did.
So
especially with permanent life.
that was the little bonus treat for the folks who have stuck with us throughout the entire webinar today, is that if you do have a permanent policy of some sort, you absolutely need to be reviewing it, even if you just got it a year or two ago. I mean, because things change and circumstances change. And so you want to be staying on top of that. Absolutely. Good point. Good finishing point there, I think.
Hey, just dropping little nuggets.
Just drop a little nugget for anybody
You
who's
stuck
stuck
around. Little treat for you.
That's right. That's right. Well, we've got a lot more nuggets of financial planning on our website. So take a look at that and let us know how we can be of help to you in evaluating your insurance, but also evaluating the entirety of your wealth and the strategies that you're currently pursuing. But thanks for tuning in for this webinar, and we look forward to seeing you again next time.